Good evening, everybody, and thank you for attending our revision class tonight. Tonight, we are looking at task 1 in advanced management accounting, which typically deals with the budgetary processes, such things as types of budget, sources of information, and forecasting. So if we look at our first topic, task 1 deals with budgetary processes, responsibilities, and uncertainties. When all said and done, a budget is essentially an educated guess as to what we think is going to happen in the future. And of course, the future can never be predicted with 100% accuracy. This task is worth 12 marks, which gives you 15 minutes to complete it. This task requires a clear understanding of the budgeting process, requiring students to consider a range of different budgetary considerations. The first of which, get my spare pen out, the first consideration is, of course, why we produce a budget in the first place. And it's probably worth just exploring that notion. We have an acronym: PRIME: planning, responsibility, integration, motivation, evaluation. So let's think. We're going to create a budget. Now, different situations, we may be an existing business and we are simply going to produce the budget for the next period of time for the products we already sell. So we've got lots of information about what is currently happening, what's happened this year. We can supplement that with information about what we think will happen in the future. It's a straightforward process. The world changes and we have to take account of what might change. But on the other hand, plenty of things will stay the same. Contrast that with an existing business that's producing a new product. Now, in that case, we have to establish that there's a market for the product. We then have to identify what kind of a price we think we can sell that product at. And then after that, then we start looking at what it will cost us to make the product, how we're going to distribute it, where it will fit our existing system. So more complex. Finally, a new business that's starting up has very little on which to base its expectations, other than perhaps looking at what competitors are doing, possibly experience of when the people involved have had a similar business before. So where do you start with a budget? If you think of the whole process of what business does, we take materials, we take labor, we have some sort of an infrastructure which generates overheads. Out of all that come products. What do we do with the products? We need more people to sell them to. So there you go. There's a 10-second précis of the entire business process. You get stuff, you get people, the labor, overheads, turn it into products, sell it to people. From them, of course, what happens is money comes in, which goes to pay for where the money goes. And if there's a bit left over, that's a profit. So we've got a budget. If it's a new product, the first thing we're going to look at are going to be these guys, because there's no point introducing a new product if you haven't got someone to sell it to. As well as considering who we're going to sell it to, we've also got to determine how much we think they'll pay for it. And part of that analysis is who's out there already selling a similar product. So step 1, we need to know who we're going to sell to, what we can sell it for. Then we have to start looking at how much we're going to have to spend for our materials, what's it going to cost us to employ people, and then Where are we going to operate? And that's going to be our overhead cost. So the whole process, it's very much the metaphorical chicken and the egg. What resources do we need to generate what income? And hopefully our analysis will tell us that the big green pound sign is going to be bigger than all the little yellow pound signs, and it is therefore worth going into business. So planning because we need materials, planning because we need people, planning because we need money. If our business is going to need to borrow money for a process, or possibly is going to run out of money perhaps next June when they're waiting for big orders to come in, the time to go to the bank and ask for that money isn't 31st of May next year, it's now. The earlier we ask the bank for help with money, the more likely they are to be forthcoming. My material's not looking very good there. Responsibility. Who in the business is going to do what? Who's going to prepare the budget? Who's going to provide the information? Who's going to make sure the production works out right? Who's going to sell the product? Integration is the whole process that the whole budget starts maybe with a pile of components and ends with money in the bank via customers along products and customers along the way. The budget isn't just about what we're going to make, isn't just about what we're going to sell. Integration is the whole process. Motivation we'll talk about in a while. A budget can be used as a target to give people something to aim for. That's my target. Evaluation. Once we've created our budget, somebody needs to monitor to see that what's happening is something like what we expected to happen. And if it's not as good as or better, then what we need to do about it. So it's a whole process, Where do we get information from, and what sort of information do we want? Sources of information available, including the appropriate management personnel that should be consulted. The various different sorts of data. Quantitative data that can be measured with numbers. How long it takes to make a unit of production. This would also be how many customers, how much material goes into our product, how many we can make. So it's everything that we can measure in terms of size is quantitative. Qualitative is not so easy to measure. Quality of our product, how happy our staff are in their jobs. So product quality, what might we measure? We might measure returns. How many come back for repair because they don't work properly? We might measure repeats. How many customers come back for more of the same because they are happy with it? We might see reviews. Take them with a pinch of salt, though. A lot of reviews get paid for. Fantastic product, they've asked me to say. Returns, repeats, reviews, all the quality of our product. Staff, how might we judge how happy our staff are in their jobs? We could wander around every day just to see who's smiling. That's not the best indicator. Retention. How many people stay in the job? It's surely a bad sign if people stay an average of 3 months in an organization. That's not a good sign. I took a job on once many years ago. It looked really good. I didn't do my research. I was very young. Turned out I was the 4th person in a year to occupy that particular seat. And that led to the least satisfactory 4 years of my life, just proving them that somebody could do the job, but it was not a good place. Staff retention. We could ask staff, couldn't we? We could do surveys, staff satisfaction. Difficult though to measure, because unless a survey is extremely well anonymized, who's really going to put that don't like the boss very much? Nobody's going to put that, are they? Not unless it's extremely well disguised. So quantitative: how big, how much, how many, how quick, how long, how slow, how fast. Qualitative: how good or how bad. We can also analyze data into primary and secondary data. Primary data is gathered for a specific, well, all data is gathered for a purpose, but when we use the data for a specific purpose, and we are using it for the purpose for which we gathered it, that's primary data. So interviews with customers, questionnaires for staff, they've been put together specifically to gather that data that we want to find out about. The thing about primary data, it's fairly obviously going to be expensive. You've got to employ people to go stand in the town centre with clipboards, shivering in the cold, watching all these people trying to avoid them and get round them and not get caught. That's, that's not cheap. It's probably difficult because somebody's got to sit down and devise the questions. Questions don't fall out the air by magic. What do we want to measure? So there are a couple of disadvantages. We can probably think of some advantages. It can be tailored to what we need. It can be a very good fit. So that's primary data. Secondary data. This is when data exists in the world and we can actually make use of somebody else's work. So there may be, maybe in a particular industry. What if we are importers of wine? There may well be data provided by the Wine Merchants Association that gives you an idea of how big the UK market was for mid-priced Riojas for the last 5 years. There may be data for how the habits of typical family with respect to wine drinking have changed. So there's lots of data out there, and if it's already in existence, it can be a lot cheaper to obtain because it's already there. You don't have to pay people to gather it. That's a big advantage. It's not necessarily, though, going to be as relevant. Just the same as for many of us, an off-the-peg suit is never going to fit as well as one that's been made to measure. Secondary data may not be quite such a good fit for our needs. So that's a couple of definitions. So forecasting budget, we've said, is all about foretelling the future. It's, on the one hand, we're forecasting sales, what's going to come in. On the other, we're forecasting expenditure, what's going to go out. So how do we forecast sales? We could make use of sales experts. I don't know what one of those is. We could certainly, our own sales staff, because of course they listen to customers that we've already dealt with. The sales staff know whether they're saying, I like you guys, I'll be back next year for another one, or that's the last you'll see of me, mate. So our own sales staff, I suppose under sales experts, we would have industry publications. So I've mentioned, you know, maybe the UK Wine Importers and Wine Merchants Association. So in every industry, there is a body that publishes information. I read some data yesterday from the SMMT, who is the motor industry's body, you know, and they were looking at trends in new car sales and making predictions of what they expect to happen over the next 6 months. So linked to our own staff listening to customers, we could do market research. You know, we could send out surveys. Everybody here use YouTube on and off. Which of the following brands have you had positive opinion of? I'm assuming you're all like me and you all have freebie YouTube and you don't pay to get rid of the ads. Which of these brands do you have a positive opinion of? Which of these have you heard of lately? So you can do surveys, which can be in person, you know, we're back to the town square with a clipboard or the shopping centre, or they could be online. So those really are both looking forward, aren't they? Sales, you know, we're talking to people looking forward, looking at predictions, we're looking at what customers say they're going to do, we're asking people to say. We can also look backwards, and these next two items really are kind of more or less the same thing. We can look back at previous results. We can look at what's already happened and happening. Linear regression, in summary, is if you've got a graph where you plot lots of data points on a graph like that, linear regression is a mathematical technique that looks at those lines and goes, ooh, that's the line that those what do we call it, a line of best fit. That's the line that best summarizes the mathematical behavior of those coordinates. And then what we can do is we can then plot a point on one axis against the line, and that will predict where we think we'll be on the other axis. So linear regression is a technique you will hear mentioned. You won't have to do it in the exam. You may be given an equation, something along the lines of units sales are X plus 200Y, you know, where X is 10,000 and Y equals the month, for example. You've seen these in practice material. That's an equation that has been arrived at by means of linear regression, but you don't have to do the linear regression. So that's all that means. Time series analysis, similar, except that in many cases our results may well have seasonality. So that might be Q1, Q2, Q3, Q4, and we can establish an underlying pattern called a trend, and then we identify that at different periods of time we have either positive seasonality or negative seasonality, where we actually do better or worse than the average. So linear regression, time series analysis, this is just analysis of the past. And so the big distinction is we've a couple looking at the future and these are looking at the past. There's one other element I would certainly take into account with forecasting sales that hasn't got a mention here, If you are forecasting sales of a luxury item this Christmas, compared to what happened last Christmas, there is one massive thing that we are hearing about all the time that is impacting hugely on how much money people have got available to spend on luxury items. And that obviously is the dreadful situation over in Ukraine. So the other thing I would look at would be the news, because all of the analysis of past results in the world and previous expectations count for nothing if we hear in the news that, you know, on average, everybody's however much worse off. So anything and everything, all information you can find is relevant, and things that happen in the news can make have a huge impact. So after sales, we have to forecast expenditure. Production and purchasing managers. So purchasing manager, he or she will hopefully have a pretty good idea of what the likely cost of material is. Production manager, he'd probably be able to tell us hours. And of course, most likely also linked in with the news, HR will tell us what our wage rates are likely to be. Market research for expenditure. This kind of links in, I would suggest, with the news. Expectations of inflation. Inflation is the thing that we've taught for many years in accounting and talked about and never seen. As you can see at a glance, I've been around long enough to remember the terrifying times at the end of the 1970s when prices were rising at one point. I think we topped out about 18%. I know my very first mortgage, turn of the 80s, well, that does tell you a lot, doesn't it? Turn of the 80s, my first mortgage at one point was, that was 15, I think, half or seven, maybe 17% it topped out at. So inflation, news regarding inflation will be certainly taken into account when we look at what we expect to pay. Production, agreed, yes. Good point in the chat there. Yep. Production manager would know volumes of material. Yeah. Number of hours and volumes. And again, we've said time series analysis, linear regression for price. Again, that all links into inflation because ultimately inflation governs all prices. And of course, as we're hearing on the news, because we're all expecting to pay a bit more for our shopping, we're all knocking on the door of our employers saying, please, sir, as in Charles Dickens, please, sir, may we have more? And of course, that then feeds into greater costs. So the employers then got to start charging more for the products that they produce and sell, and which in turn means, and this is how inflation works, this is called the inflationary spiral. Depressing do tonight, isn't it? Sorry. Responsibility and approach, things to consider. Responsibilities of, and not every business will have all of these because it really does depend a bit on the size of the business now. So we may have a budget committee, a budget accountant, and then senior management's accountability once the budget has been approved, because senior management's job is to achieve the budget. Back in the day when I used to be given or negotiate a budget that I had to meet. I well recall the management meetings where the FD would sort of sit there like the Cheshire Cat, smug as you like. They'd be like, here's your budgets, lads. And I remember thinking, yeah, he's giving out the budgets, and it's not his problem if we struggle. So who, look at a scenario in an exam question. The size of business will tell you what kind of level of complexity the budget process will involve. I've been in a situation where I've had a phone call saying, a little job for you to do, can you do a budget for that department for next year? And that was I was the budget committee and the budget accountant on a phone call. Alternative approaches, budget participation, and the benefits and limitations to each approach. And of course, the two that we hear about the most. A lot of stickmen tonight. I'm getting quite fluent with these. So these are obviously the management because they're wearing posh hats. And here are we, the workers, down the bottom. Tell we're workers because we've got spanners. No, it wouldn't actually be at that level, would it? No. So we've got the people at the operational level. We've people at the strategic level. So do they simply hand down the budget and say, here you go, get on with it? Or do they ask for input from below? And is the budget somehow negotiated in between? In truth, it's not that often that a budget will simply be dished out without any consultation. But of course, the relative amount of consultation from the people at the sharp end will vary by organisation. To an extent, the bigger an organisation, the more likely it is that large amounts will be determined high up. So the NHS will be told by the government, here you go, here's so many billion, and then that'll be divided, and there'll be relatively little input from doctors and nurses and ward managers into what budget they get. There'll be relatively little because the size of that organisation really makes that very difficult to achieve, and that's a major factor in the approach. Make sure you can talk about the benefits of top down. So top down can be quick. There you go, there's your budget, job done. But it may be unrealistic. Bottom up advantages, expertise. The people at the sharp end should really know what's going on. So it ought to be achievable. The downside is, of course, it might be too achievable. Because, as we know, budgets may well be used as a basis of reward systems, and nobody wants to be landed with a target that's so remote they're never going to earn a bonus. So make sure you can picture the potential advantages and downsides of each. Consider the level of motivation. We'll talk about motivation in a minute. Control, experience, and flexibility in resources to help identify which is appropriate. Methods of dealing with uncertainty. As we've said, if you're setting a budget, you're setting a plan for the future, and the future is never ever going to be a certain thing. Lots of people in red and white shirts seem to think England are certain to win the World Cup over there in Qatar, but I don't think it's quite as cut and dried as that. Use of planning models. The great thing we can do with computers, of course, is we can simulate. What if this happens? What if that happens? Even just using spreadsheets compared to not that far back in history, we have a much better idea of what will change if this changes, if that changes. Regular revision of budgets and the implementation of rolling budgets. A fixed budget. What if your company launched a fixed budget for anything to do with energy in January of this year? As soon as you've hit March, it's starting to wobble. By the time you've hit June, your budget is history. It's nonsense. If you've got a fixed budget 3 months after the catastrophe started to unfold in the East, then your budget is meaningless. So a rolling budget we constantly review and update, and it gives us a chance to react to changing circumstances. As well as demonstrating an understanding of the above, you may be required to carry out the following requirements. Classify and allocate direct costs to appropriate responsibility centres. Implement recovery methods in order to deal with indirect costs appropriately, which means overhead absorption. That's how we recover our indirect costs. We build them into the cost of our products. And then that might mean an exercise using traditional labour hours or machine hours, or it might mean sharp intake of breath, ABC, which always seems complex, but if you read data carefully in an ABC question, it's pretty obvious that maintenance costs are going to be driven by maintenance hours. It's pretty obvious that the store's costs need to be shared on the basis of who's forever rattling on the hatch and taking up the store's time for store's issues. So read the data carefully if you get one of those. You need to apply responsibility accounting in order to consider the nature of costs within a given responsibility sector. And costs can be controllable or uncontrollable. We keep going on about what's happening in Ukraine. Your gas supplier, no point giving your gas supplier a hard time about your gas bill, because the cost of gas has gone up beyond the control of anybody in the UK, let alone within an individual company. If there is flooding, if you've got a component you buy from one main supplier, and due to climate change, their production facility gets flooded and shuts down for 3 weeks, no point giving your purchasing manager a hard time that you're short of raw materials, or that you're having to pay over the odds for an alternative supplier. That is uncontrollable. A lot of common sense, as with all management accounting, a lot of common sense in this. Motivation. There's a rather splendidly named chap called Vroom. What a great name that is. Hi, I'm Vroom. And his theory of motivation was that the amount of motivation an individual feels is the product of two factors: valence, which is how much you want something, times expectancy, which is how likely you think, not actually how likely it is, but how likely you think you are to get it. So if you're offered something that is a fabulous thing to have, right, top salesman this month gets a week in the Maldives. Woo, hey, go for that. You know, even if there's only 1 out of 100 of you going to get it, you're going to give it a good go. Well, I would. On the other hand, you know, anybody who makes target will get an extra 30 quid in the pay packet. And as long as if your target's achieved, well, I'll go for that because I should easily get that. So if I think it's easy to get, even if it's not worth a lot, I'm going to go for it. So the harder something appears to be and the less valuable it is, the less you will try. Where this fits into budgeting is that, number one, a budget therefore must create a challenging target because the business needs growth. The business needs to achieve. So that's for the benefit of the business. But it must be achievable. Otherwise, nobody will try. Because if their expectancy is very low, then, well, what's the point of flogging yourself for 3.5 weeks just to realize that you're a week from the end of the month and you're 50% away from it? Now, we've said about controllable and uncontrollable items. And here is where these two items, I don't know if these are the right way around, really. To improve our valence, we can link a budget to reward schemes, which might be a bonus. I don't know about you. I really like working for any employer who actually says thank you. You know, you get a little message saying, I heard about your idea. What a great idea. Nice one. Well done. So a reward scheme doesn't only have to be a bonus, but, you know, a thank. So if people feel that they get a pat on the back in the meeting, oh, Fred over here's made his bonus this, you know, he's made his target this month. Nicely done. You know, brilliant. But either way, some sort of reward, but there's no point offering any kind of targets or rewards, anything over things that are not controllable. So don't give your production manager a bonus on the basis of how many units get sold, because he's not doing the selling. Maybe give him a target for how many he has to produce, and it's the sales manager's problem. So targets must involve items that the individuals concerned have some influence over. Otherwise, what's the point? I love that name. Okay. So here's an example task. This is about types of data. So if we call those 1, 2, 3, 4, and 5, with type of data box on the left with appropriate source. So competitors' prices. The trick with multi-choice is to rule out the ones that it isn't. Well, HMRC are not going to tell you anything about competitors' prices. Well, that one could. That one maybe could. The FT's unlikely to, and the ONS certainly isn't likely to. Choice of 2. We'll leave those floating. Share prices. Well, HMRC are not going to tell you a lot about that, nor is your competitor's website, nor I suspect is the Trade Association. The FT certainly will, and I don't think the ONS will. Oh, so there we go. One down. VAT rates. Well, HMRC probably will. I doubt your competitors will. I doubt the Trade Association will. Not really. So there we go. Sometimes they'll be easy, other times not. So competitors' wage rates. HMRC are not going to be able to help, but they're done anyway. We've done that. Competitors' website, they're not going to want to tell you that. The Trade Association certainly will. FT won't. The ONS won't. So there we go. We've done another one. And that also means that only leaves us competitor's website for that one, which we might have picked anyway. It's the process. Industry Trade Association, in every sphere of activity, there tends to be a body that has the interest of that industry at heart. I mentioned earlier the SMMT, the Society of Motor Manufacturers and Traders, and they look out for the interests of people who make cars and who sell cars and look after cars, and they produce statistics for new car sales. They produce statistics for what else do they do? They're really into sales, mostly volumes of cars. They petition the government in respect of legislation that affects cars and things. So they an industry trade association is a body that's set up to look after the interests of the industry. You know, so there might be a millinery association that looks after hat producers. It looks after footballers. Does the Football League count as a trade association, the Football League? But that's it. It's they won't help with wage rates, but a trade association will have a lot of information about people in that industry. So they'll produce statistics for typical wages and salaries within that industry. So all we've got left is inflation rates, and sure enough, the Office for National Statistics will indeed do that. So often you'll find there's overlap, as we saw really with the pricing. So you can often rule them out, and generally some will come out easier than others. So that's a method to adopt when you get one like this. Oh, once again, boxes in the left to the budget on the right. 3, 4, 5, 6, and 7. Factory workers' wages, capital expenditure. I don't think they have an awful lot to do with wages. Capital expenditure is, of course, non-current assets. Cost of production, well, that's a definite possible. Cash flow, not really directly. Factory workers aren't working in the office, nor are they actually selling the product. So there we go. Cost of production. Sales staff salaries, they're not capital expenditure either. We've already done cost of production. Cash flow, not that they'll come cheap, of course. No, not admin. Sure enough, marketing and distribution budget. So there we go. That's that one done. Office staff. Well, we've just seen that one. That's an obvious one, isn't it? That's that one done. Hire of machinery. Now here we've got to be careful, because it's high. It's machinery, which is often a non-current asset, but it's higher. So I wouldn't put that as capital expenditure. I'd be looking to put that as cost of production, because we use machinery for production. So actually some of these can be in more than one. Some of these have more than one answer relevant to them. Purchase of new machinery, that is, of course, capital expenditure. So I'm going to use another colour for that. We're running out of colours here. Getting a bit confused with all that. There we go. Raw material usage. Well, that's one of the elements we need for production. It's not admin, it's not marketing, it's not capital expenditure. Receipts from customers. In answer to the question you've asked, Magdalena, the receipts from customers, that'll go into our cash budget. Now, this is oversimplified if we're honest, because ultimately everything ends up in the cash budget because raw materials have to be bought. So they ultimately the cash budget, in many cases we have different functional budgets. We'll have a budget for raw material, budget for labor, but they all kind of come together in a master budget that controls all of the budgets. And cash flow really draws information from all areas, because if you think about it, what involves cash here: wages, salaries, hire, purchase, got to buy raw material, and customer receipts. So arguably you could actually draw a line from those two. Really, if we're being honest, they all would affect cash flow. But I think we're looking in an exercise like this for the one that is the most immediate direct match. A lot of management accounting isn't really that black and white. A lot of it is logic and common sense. Complete following sentences by selecting the appropriate term. A process where budgets are prepared by simply taking the budget from the previous period, adding a little bit on, to reflect expected increases in volume of prices. And this is called, well, bottom up. We've already talked about that. That's where we take input from people on the shop floor. So that's nothing to do with basing it on last time. Your answer is correct. We'll talk through why. Top down, we've already said that that's people on high, wearing top hats, handing it down to the rest of us. Rolling, we've said, is where really we are constantly changing throughout the year. Zero base is where everything is done from scratch every time. And there it is, incremental budgeting. Budget flexing, that is where we change our budget when we are comparing what's actually happened with what was expected. There's no point comparing material costs for 9,000 units with what we expected to spend on 10. We flex down our expectations. And budget revision is just changing a budget. A process where budgets are regularly updated to add an additional period at the end of each period. So we have a budget, a budget, a budget, a budget. And when that one's gone, we have another one. What's it doing? It's rolling. Think of how the Egyptians built pyramids. Egyptians built pyramids. They had these massive blocks of stone, and like that weighed about 50 or 100 tons. And that's what they did. They rolled them on logs, and as they cleared one log, they took it, put it in front. So picture those blocks of stone that the Egyptians used to build pyramids, and then you'll remember rolling budget, because it's not cast in stone. The process of measuring actual results against a flexed budget to identify whether performance is better or worse. A performance indicator, that's a measure of something. A variance is what you're going to come out with when you've done this. A performance review is what you get a couple of times a year and you hope it goes well. Variance analysis, there it is. Material cost variance, labour cost variance, these are all bits that come out of the variance analysis. But variance analysis is the process of comparing what happened with what we expected. I think this is our last question. Which of the following are objectives? So we're looking for things that are why we produce a budget. So which ones are yeses and which ones are no? So is it to enable a reward scheme to be linked to controllable performance by assigning responsibility for business area costs, revenues, or both? Well, it certainly is. The key word is controllable there. That if it just said performance, we might have to be a little bit careful. Does it force managers to look at the future and to set out detailed plans that will allow them to achieve targets? Hopefully so. Ooh. Does it assist in the assigning of responsibility for performance of a budget area without the need to authorize decisions about costs? Decisions about costs have always got to be authorized by somebody, haven't they? So that's not good. Does a budget assist good communication and ensure coordination between departments? Hang on, this sentence doesn't work, does it? Maybe we should say ensure that good communication between departments is happening and encourage the business to operate as efficiently as possible. Well, it's all about coordination, isn't it? That is one of the big words for a budget. Enable management to adapt targets to align to their current performance. So that's a bit like if your football team's got a centre forward who can't see straight, and that's not big enough, you give him a bit bigger goal to aim at with the hope that eventually he'll put one in it. That's not very good, is it? With a bit of better wording, enable management to set targets based on achievable performance. Not so bad, but allow management to identify and improve the performance of the business in the future. You're looking for opportunities all the time. Well, thank you everybody for attending tonight. I hope that's been a useful session.